this data that you're looking at now, I hope this is visible. This data that you're looking at now, this is from the S&P 500, the futures market, right? Because the market was actually not open that morning yet. It was early in the morning when the two airplanes crashed into the Twin Towers. But the futures market was open. I also collected, it's not on here, I also collected the British data at the same time. But let's sort of focus on the American data. And I think this tells you, and this data, each of these blue dots is one transaction on the S&P 500 futures market on that morning. So let's take a look at what happened. And what I did is I took this data, and then I found we have a timeline. People know exactly what happened that day, to the second. We know what happened on that day. And I lined up the data with the news of that day. So here we are in the morning, and the S&P was 1100 and something. At 8:20 a.m., Flight Center determines that American Airlines Flight 11 is hijacked. What happened to the stock market when that happened? Nothing. Right here, right now, I can tell you that the strong form of market efficiency is violated. It is not strong form efficient, right? There was information. There was a hijacking. Did anybody know that the hijackers were going to crash them into the World Trade Center? Well, at least the hijackers knew that. So at least hypothetically there was information, but obviously the market doesn't react to it because the people buying and selling don't know that information, right? And so therefore it should happen. And the price, kind of moves along. NORAD notified of Flight 11 hijacking. Here we are. I'm sorry, the time down at the bottom, 8:36. I've got the time on the bottom. And then let's take a look. This is where things start getting interesting and tragic. 8:46 and 40 seconds. Flight 11 crashes into number 1 World Trade Center, the North Tower, right? That's that red dot over there is when it crashed in, okay? And let's see what happens. The first thing that happened is, for the first minute or so, nothing happens. An airplane, so when you ask a question about market efficiency and you say, how quickly does the market react? For the first minute or so, it didn't react at all, right? Even though this happened right in downtown Manhattan, it didn't happen because nobody thought much of it, okay? And then the market starts going down. But look, it wasn't even on the news yet. The first reported broadcast from local New York news was 8:48:08, right? So it was like a minute and a half later was the first one. The market actually started coming down before the local news. So I'm kind of telling two stories here. One is the market didn't react immediately to the second. But I am telling you, the market is pretty darn smart. The market started reacting before the local news did, right? People started trading, I guess they saw with their own eyes that something was going on there. The market started visibly going down. But you know what you might say? You might say what really matters, right? What really matters is national news. When did it get on CNN? When did the national news happen? Well, CNN, 8:49:34 CNN is the first one to broadcast. That's right down here at the bottom. Right? By the time CNN reports, hey, a plane has crashed into the North Tower, the market has already gone down by 1 or 2%. And in fact, it starts bouncing back up again. Right? It starts bouncing up. So if you thought CNN is actually, it's like the worst possible time to trade on it, is that by then the market's already down and then the market starts bouncing back up again. And this also tells you, again, those of us who are alive at this time, or not just alive, but alive and adults, and we remember it, you read this and you kind of remember what happens, right? I remember what happened, right? First plane crashes into the World Trade Center. I remember that news, okay? Plane, yeah, it's must have been some small commuter. Boy, somebody's, this is terrible, right? Terrible news. Some plane crash. Must have been some small private plane or something like that. Yeah, I remember back in World War II, a small military plane once crashed into the Empire State Building. Something like that happened. It's a terrible accident, right? It's just an accident, right? But in the grand scheme of things, right, the price goes back up. And then this is when CBS and CBC, Fox News starts reporting it, right? But by the time they start reporting it, it's already done. The stock market has already done its thing. Look, and the President Bush isn't informed until here. But then this price starts going down because now people are starting to think, wait, I heard maybe it's not a small plane, maybe it was an actual airliner, right? And then the market starts going down. But take a look what happened. 9:02:57 is when the second airplane hit, right? That's this red dot. What happened when the second airplane hit? The price drops immediately within seconds, the price drops. Not only the price, you see a little discontinuity here, and the price goes way, way down here, and then you get this crazy volatility the rest of the day. I mean, this crazy things are happening, right? So this goes to the idea of our interpretation of market efficiency is when the first plane crashed, it took a minute or so until anything reacted. The second plane crashed, it took just mere seconds for the marketplace to react. Why? Why was the second one? Because when the second plane crashed, everybody saw it live on television. People saw it live on television. They knew immediately that something was happening. And the first one, it could have just been an accident. When the second one crashed, you knew that something terrible happened, right? You knew that there was something that was intentional. You knew that it was, you knew that this was a really, really big deal, that it was intentional, and you knew something. And so the market. So again, this goes to the idea of, again, I'm just sort of tying this back to market efficiency. What does it mean the market's efficient, that markets react quickly? Well, here in this little picture, we see quickly means different things in different contexts, right? The first airplane crash quickly means a couple of minutes. The second airplane crash quickly means within seconds. So it depends on, sometimes the news is traveling faster, sometimes the news is traveling slower, right? In both of these cases, it's fast, but one case it was super fast, one case it was not as fast. In the case of the space shuttle, it was, you know, tens of minutes or an hour or so before the market starts figuring things out. Here you see it happening really fast. So I think this tells you a lot about market efficiency, right? I want to comment one other thing about this is that, you know, people look at this, which I think is really interesting from market efficiency perspective, but it also makes you wonder, are people so bloody minded? You know, here they are, they're working in downtown Manhattan, and my God, someone crashes airplanes into a building, kills thousands of people. I think I'll short sell the S&P 500. Is that what happened? Is that what people first thing they were thinking about was their portfolios, right? And I think that is a very ungenerous interpretation. I don't think that's what was really happening here. What I think was happening, again, let's sort of focus on the second airplane when market reacts immediately, right? Your job is you're a trader. You are buying and selling, and there's a computer. You're buying and selling online. There's a computer that's matching up the buyers and the sellers, trying to find a point where the supply curves and demand curves cross. People buying and selling, and you hear this news going on that some airplanes crashed or something. And what happens is you're in the trade on the trading floor, and in the corner of the room there's a TV in the corner of the room playing live. People are talking about it. People are standing around watching the TV. And imagine again, right here, 9:02:57. You are about to make a trade. Either you're about to push the button that says buy, or you try to push the button that says sell. Let's say you're about to push the button, right? And then, right as you're about to push the button buy or sell, you hear somebody in the corner of the thing watching the television going, "Oh my God, I can't believe it." What is your reaction as a trader going to be? If you were about to push the button that says buy and someone screams, "Oh my God, I can't believe that," what do? You pull your hand back, you take a look, and you say, "What happened?" Right? And you'd hold back, and then you'd start hearing what happened. Then you start thinking about whether or not you do it. On the other hand, if you have a position and you're about to get out of your position and you're about to hit sell, and someone screams, "Oh my God," what's your reaction going to be? Your reaction is going to be is to push the button that says sell, and then turn your head and say, "What happened?" Well, you know, tell me what happened. And I think that's how you're going to have. So then the computer sees an imbalance there, the price suddenly declines because you have all these sellers that are still in, whereas the buyers suddenly pull back, and that's where the price starts falling, and then people start thinking more rationally. But anyways, I think it's just really interesting to be able to I'm glad that I got this data, and I think you look at this and it does the two things. It helps me understand better what market efficiency means, and it also just reminds me about what I was thinking during that day. I think it's really interesting.